Imagine a single government decision that instantly wiped out $20 billion in market value and threatened $150 billion in future contracts. That's exactly what happened when China ordered its airlines to stop accepting Boeing planes, making the world's largest aerospace manufacturer collateral damage in an escalating trade war. With each Boeing jet potentially worth up to $500 million in lifetime revenue. This isn't just corporate drama. It's a seismic economic event that could reshape global aviation, impact thousands of American jobs across 50 states, and signal a dangerous new phase of economic nationalism where no industry is safe from political weaponization. Welcome to the new battleground of modern trade wars, where commercial aircraft have become the latest casualties.
China's government has reportedly ordered its domestic airlines to stop accepting deliveries of Boeing jets and to halt purchases of aircraft parts from the U.S.
Shares of Boeing under a bit of pressure this morning. Reports the company is the latest name getting caught in the crosshairs of the trade war with China. Phil LeBeau has the story for us. Phil.
China's Boeing ban, a strategic strike in the trade war. The U.S.-China trade conflict has dramatically escalated, with China's Civil Aviation Administration ordering its airlines to halt all deliveries of Boeing aircraft. The move is a calculated response to the Trump administration's aggressive tariff policy, which has imposed tariffs of up to 145% on Chinese imports. The immediate market reaction was devastating. Boeing shares plunged 9 to 10% within days, wiping out $15 to $20 billion in market value and shocking investors worldwide. The scale of this action becomes clear when examining Boeing's extensive Chinese market exposure. Of Boeing's global order book containing roughly 4,500 aircraft, Chinese airlines and leasing companies account for approximately 1,200 planes, representing 26 to 28% of Boeing's total orders. With narrow-body jets valued at $110 million and wide-body aircraft at $300 million each, before considering maintenance and parts contracts that can push total lifetime value to $500 million per plane, the Chinese market represents $10 to $12 billion in annual revenue for Boeing. For fiscal year 2024, Boeing recorded $7.4 billion in deliveries to China, projecting growth to $9 to $10 billion for 2025. Now these projections face potential collapse to near zero if the ban persists. This catastrophic timing compounds Boeing's existing financial challenges, as the company has already suffered over $20 billion in losses related to its 737 MAX problems during the pandemic. Analysts predict that if China maintains this position for 6 to 12 months, Boeing could see its overall delivery revenue plummet by 20 to 25%. Economic ripple effects across America's industrial base. The Boeing dispute transcends corporate impact, threatening significant damage to the broader American economy. U.S. exports of civil aviation equipment and aircraft total approximately $130 to $140 billion annually, forming a critical component in addressing America's trade deficit. With China representing 15 to 18% of this export market, the ban threatens billions in negative impact on America's trade balance. More concerning is the extensive reach of Boeing's supply chain, which spans all 50 states and encompasses thousands of smaller companies manufacturing everything from engine parts and avionics to seats and landing gear. These businesses, many in Middle America, depend on orders for aircraft and components destined for China. Industry experts project that engine parts manufacturers alone could shed 5,000 to 10,000 jobs by late 2025 if the conflict persists. With Boeing employing roughly 140,000 people, 30,000 specifically in commercial airplane production, every percentage point decline in profit margin could translate to thousands of lost jobs. Economic protectionism designed to strengthen America may ironically damage American workers first, creating a boomerang effect that hits hardest in manufacturing communities nationwide. The potential socioeconomic impact reaches far beyond Boeing itself to affect thousands of supply chain companies and millions of employees and families. Before we dive in, do us a solid, hit that like and subscribe button. It keeps Globelines going strong and helps us connect with more informed viewers like you. With that out of the way, let's move on to our next part. China's aviation dilemma, short-term pain for long-term gain? While China's decision creates significant challenges for Boeing and the American economy, it also imposes substantial difficulties on Chinese airlines and the country's aviation sector. Chinese carriers extensively utilize Boeing 777, 787, and 737 MAX models for intercontinental flights. Transitioning to Airbus alternatives requires new pilot training, maintenance infrastructure adjustments, and spare parts acquisition, costing millions in additional expenses and requiring months-long transition periods. Beijing appears to be operating under the principle that we will suffer, but America will suffer more, accepting temporary disruption to its domestic aviation industry to achieve broader strategic goals. Chinese airlines have plans to purchase more than 500 new aircraft over the next decade and have been negotiating with Boeing for many of these orders. If these plans are canceled, China faces a significant aircraft shortage that neither Airbus nor domestic manufacturer COMAC can immediately address. The Chinese government's strategy includes strengthening its relationship with European manufacturer Airbus and accelerating development of its domestic commercial aircraft producers, particularly COMAC's C919 and the Russian-Chinese joint CR929 project. However, COMAC's production capacity remains uncertain, and ramping up to full-scale manufacturing will take considerable time. This creates a challenging transition period where Chinese aviation growth could be constrained by aircraft availability. Global aviation market restructuring and industry power shifts. The dispute potentially triggers a fundamental restructuring of the global commercial aviation market, traditionally dominated by the Boeing-Airbus duopoly. If the conflict continues, Boeing risks permanently losing market share to competitors. In 2024, China's combined orders from Boeing and Airbus totaled approximately $14.5 billion. If Beijing diverts additional orders to Airbus or accelerates domestic production, Boeing's share could shrink to $5 to $6 billion annually. Industry rumors suggest Airbus may announce additional deals with China at an upcoming press conference. An Airbus order of 150 units would devastate Boeing's Chinese market position, a scenario Boeing executives describe as our worst-case scenario. Airbus has carefully positioned itself, stating, "We do not intend to take advantage of trade wars, but if the demand comes, we will do our best." Their stock has already seen upward movement as investors anticipate increased Chinese orders. Perhaps more significantly, this conflict could accelerate China's determination to develop a self-sufficient domestic aerospace industry. The COMAC C919, China's answer to the Boeing 737 and Airbus A320, could gain momentum as Chinese airlines face pressure to support domestic manufacturers. While currently not competitive with Western aircraft in terms of technology and efficiency, increased investment and political backing could accelerate COMAC's development timeline, potentially creating a third major player in the commercial aircraft market within the next decade. Trade war escalation and the future of global economic relations. The Boeing situation represents a dangerous new phase in the US-China trade war, where previously protected sectors face weaponization. If this pattern continues, retaliatory actions could spread to other strategic industries including chemicals, agricultural products, and semiconductors. Analysts warn this could trigger a full-blown trade war that would shrink exports on both sides and increase recession risks for the global economy. Neither side appears willing to compromise. President Trump has blamed Beijing, stating China walked out of the Boeing deal and China bears main responsibility. They were hurting America with unfair tariffs and currency manipulation. Meanwhile, Chinese officials assert they are playing their trump card because of the tariffs. Boeing's lobbyists have warned congressional representatives this trade war will affect us not just for the next 10 years, but for the next 30 years. It could make it impossible for us to ever enter the Chinese market again. The standoff illustrates how protectionist policies and economic nationalism are expanding under national security justifications, with global companies caught in geopolitical crossfire. Some analysts predict eventual negotiation between the two powers, at least in critical sectors. However, without such agreement, the Boeing crisis could deepen with new retaliations triggering further escalations. If you enjoyed this analysis, be sure to subscribe to Globelines, your ultimate destination for economic insight, global shifts, and every twist and turn in the political and financial landscape. Thanks for watching. Until next time, stay informed and keep your insights sharp. You can watch any of the videos on the screen now. There's plenty more to dive into.